Welcome to this episode number 19 of Your Next Trade, called today Higher Terminal Rate. So the Fed now is expected to be more hawkish than it was a month ago, meaning the terminal rate, the way the Fed is going to be implementing rates through that cycle, is going to be higher for longer. So as we're going to see, we have been moving the higher rates, the terminal rate from June to September, and probably the Fed is going to be less dovish as it was expected to be a month ago. So let's start, as always, with the year-to-date asset performances. So the picture for stocks in blue here is more or less the same, with the S&P up 6.3%, the Nasdaq up 12.6%. Europe has been very strong as well, with the Euro stocks up 12%, FTSE up 6% and made new highs. So if we look at the DAX, if we look at Europe, many indexes made new highs for the week. Now looking at the FX, as we can see, dollar is flattish versus most currencies. But that's, as we're going to see on the week to date, we're going to have a different pictures. Bitcoin, Ethereum up 30%, so still risk on for those two. WTI, gold, and copper very strong, up 7.5% on the year, and WTI for the oil trending in a range between 72 and 82, 83. Natural gas, both in the Europe and the US, still down 40% plus. What about the week-to-date asset performances? So we had a week very different from the start to the end. We had a strong start of the week until Wednesday. So we had the FOMC meeting, not the FOMC meeting, sorry, a follow-up from the Fed chairman on Tuesday. So there was an interview, live interview. The market reacted pretty well first, and then at the end of the week, we really struggled for the equity. So if we look at the overall picture, S&P down 2.4%, Nasdaq Composite 3.4%, the Russell really underperformed. So Russell 2000 is more US oriented than the S&P and the Nasdaq, which to a certain extent as well, it's more about small and mid caps, which have been underperforming the overall market. Euro stocks flattish for the week, so pretty okay. MSCI World down 2%. For the currencies, something that I flagged last weekend, saying, the dollar was expected to be stronger. So we had a reversal last Thursday. I don't know if you remember, after the ECB meeting, when we were trading around the 110 euro dollar. And since then, dollar has been very strong. So that's almost a 3% move since the highs of the euro from 10 days ago. And on the week, the dollar risk off after the risk on that we have. And that was a good leading indicator around the asset classes of a possible turnaround. So if you've been on the Discord channel, that is something that I flagged on Thursday. I always try to flag important things. So that was 10 days ago. It doesn't really be very helpful to be on Twitter and reading 50 tweets per minute. You should be more looking into really at the drivers of the market. So dollar turned 10 days ago, and we had a follow-up for this week. And as we can see, the risk off as well on the Bitcoin and Ethereum. WTI was mostly up yesterday on the Russian story that they're going to be cutting production by 500,000 barrels, which represents roughly 0.5% of the world production / the world demand as well. Copper flattish on the week. So what about the year-to-date industries performance? So picture is more or less the same as last week. No, not that many crazy changes. As we can see on that side of the spectrum, semiconductors still very strong. There have been some talks. I think it was SocGen, which was still very positive on that sector for the week. So sectors that some of the sectors that underperformed in 2022. So we had a reversion to the mean until a week ago in 2023 on those industries. If we look at the week to date, that is very much the kind of picture that we will have from the your next trade in 2022, where the dollar was very strong and most industries will have been lower on the week. What is interesting, if you look at the S&P that is here, you can see that many industries underperform. So again, some dislocation in the market, some divergence. Online retail down 9, telco down, internet, silver. But as we can see into the next slide, going into the week-to-date sector performances, as we can see, the sectors that really underperform, we are talking telco, we are talking real estate, we are talking utilities, are mostly the sectors that are driven by rates. So meaning that when yields are going up, those sectors will be struggling, because if we look at telco, if we look at real estate and utilities, those three sectors do have a high leverage in their balance sheet, meaning that they have a lot of liabilities, a lot of debt. And when interest rates are going up, that is obviously a negative to them. So that explains, as we're going to see in the next tabs, why those three sectors have been underperforming. The only sector positive on the week was energy. So energy very strong, with oil not moving that much, but actually we have seen many oil majors, especially in Europe, with the name like BP, even Total, Equinor, that were pretty strong. I'm talking BP up, I think, 50% on the week. Why? Because some oil majors now are clearly saying, no, we go back to our business model, which is about making oil and producing oil, and the market really liked it. On the year-to-date performances, as we can see, the defensive, the healthcare, utilities, still struggling for the year, whereas at the other end of the spectrum, the consumer discretionary and IT has been doing pretty well, with consumer discretionary a bit distorted by Tesla. So now let's look at the rates. Let's look at the 10 years and let's look at the 10 versus the 2. So the 10 years, what is interesting from that picture is, if I manage to do it up, I'm going to do. So if we look at the week-to-date move on the 10 years, we are up 0.21%, meaning 21 bips. So we went from roughly 3.5% to 3.7%. So that is quite a move. We are still way below the levels that we had in September, October, around 430, 440. If we look at the 10 versus the 2, actually the inversion of the yield curve has been reaching levels that we haven't had. I don't know if it was 20 years or something around this. So we are negative 78 bips, which, some market participants are saying, this time is different. We should not be looking at the inversion of the yield curve. I think Goldman Sachs is saying something around those lines, because the market is different, because of the QE, because of the Fed. When people are starting to tell you that it's going to be different, it's not going to be different. So higher terminal rate. So this one is important. This is for the euro dollar. And this is more or less about how the market is pricing the Fed going forward. So I'm looking at the terminal rate here, which is the September 2023, where we have now the expectations to be the hike until September 2023, whereas before, if you remember, the peak was June 2023. So the first thing is the market is pricing higher for longer. Okay, so higher first, so higher because we are moving from June to September, and then for longer. So if we look at the blue line versus the red line at the bottom, so the red was at the last FOMC meeting, and everything has been coming lower. Okay, lower means, in other words, if it's going lower, the rates are going to be higher. If you think about something as the December on the 27th of January, which was trading at 95.33, now we are trading at 94.88. So that's roughly 45 bips in between, 45 bips, which is almost 50 bips. So in the matter of 10 days, or since the last FOMC meeting, the market is pricing 50 bips more of rate hike between what it was 10 days ago and what it is now. Interestingly as well, you see that the cut are only starting from September onwards, so less aggressive, much more hawkish views for the FOMC going forward. So really important, higher terminal rate for longer. So you can be looking at two things. You can be looking on one hand, that is probably that the market is pricing a soft landing, or soft landing maybe later in time, or not even more, not even even any landing, and as well that the market is pricing probably higher inflation, sticky inflation. So sticky inflation means, you know, higher yields. That means US dollar stronger, and that means as well, if we look at stocks, that could mean as well that the pivot that the market was pricing is not necessarily going to happen as soon as expected, that it's going to have impact as well on margins, because higher dollar and as well higher inflation means lower margins. So what about the VIX? What is the VIX? Unfortunately, I didn't put it. So the VIX was at 21% yesterday, roughly. So we had a change in the VIX, so 20.53 here, as you can see. So we're still gonna have we're still having this normal VIX term structure. So no panic yet. Nothing is. I'm not gonna say that everything is under control, but what was really interesting before, and as I flagged in January, is the volatility. Both the realized volatility and implied volatility was coming lower week after week, and was trading below the recent level that we had. Now it seems that volatility is back, both on realized and implied. So that means we could have a bit of action again. Now let's switch into the technical analysis, looking at the S&P 500 through the S&P futures. Here you have a weekly chart. So if you use TradingView, you can change here, putting the weekly chart. So no new highs for the week. The 4200 level is an important level. We have been breaking higher this downtrend, but so far no big follow-up. If you look at the Nasdaq, this is the same picture, breaking, but the highs and the lows of the week are inside last week. So this is an inside week, and we are still expecting, you know, what is the next move. The Russell, the picture is the same, with a bit of underperforming, as I mentioned. Emerging market, something that I flagged last week. That was the start of a red candle, not looking very pretty. So, and if you look at many stocks that are China oriented, the price action is not that great, or they are, you know, trading sideways. So the high expectation on China reopening are kind of coming down. Here we are looking at the stock 600, where the candle, if you look at the DAX as well, let me put the DAX for the German index, so you don't have such a nice candle. Maybe this is only one candle for the weekly, but the picture is not very strong. If you look at CL1, so the oil, something that I've been flagging over and over, we are in this trading range 70 to 83. Now, you know, with the news coming, it feels more and more like Russia is going to be playing this production that actually OPEC clearly doesn't want oil to go below 70. So are we going to go lower than the 72? Feels very much like the trade is now on the way up. What about the copper? Copper consolidating as well, not much. I'm more interested into the euro dollar. So euro dollar, big move, as I mentioned last week, the weekly, and now there is some follow up. Same with the Japanese yen. So we had some announcement about the next Bank of Japan governor. And actually, the market was not that excited about that news for the yen. A few charts looking at Google. So Google made the headline. They did a bit of, sorry for my English, a bit of fuck up with their artificial intelligence. And what now they are trending on the support, the trend that we have here. So we are bang on the support, very weak for Google, really struggling. You don't have that many often the stock moving like this. What is important as well, if you look at the bottom, you see the volume, so very significant volume, and a lot of expectations and churning of book or rotation into those names. Tesla, Tesla up 100% from the lows. I traded on Thursday to Friday, the 0 date to expiry, or the 1 to date expiry put, because I think it was overextended. So call me lucky, but it worked. You have many names that move like crazy, but the underlying of some of those names is, if you've been playing that as a trader, it's fine. If you are playing those names as a long-term investor, and if you don't understand the basics, you'll be dead. And that comes from someone who started, trading. I had no idea what I was trading. I was really trading the tape. But in the long run, if you want to make money, it doesn't matter your time frame. You need to understand the fundamentals. And if we look at BBBY, that is a good example. They get tons of examples where retail traders, unfortunately, are excited by the tape, excited by thinking that it's easy to make money, and then the reality is they got absolutely murdered by the professionals, and BBBY is a good example. So let's go back into the week. What happened this week? So this week, as I said, we had Powell on Tuesday. What we have here is the secured overnight financing rate here, the SOFR for the September. So we started actually to have the move last week, and we had the follow-up for this week. So the market is pricing, as I said before, a higher terminal rate from the Fed, more hawkish from the Fed, higher and longer, whereas the S&P, for many equities, we are close to the recent highs, 2% from the S&P and 2% from the Nasdaq. So I think this is really something to keep an eye on, where the credit market has been already moving, and so far equity have not been moving that much. Now let's look at the earnings through the earnings season. S&P 500 earnings growth year on year -3%. You can argue on one hand, if you are bullish, that we might have done the lows in terms of earnings growth in Q4 of last year. On the other hand, you can argue as well that there is a lot of destocking that has to be happening, that the market is pricing a lot of things happening nicely in H2, which I think is not going to happen. So if there is correlation between the S&P level and the S&P earnings, then we don't have a good earnings season, no matter what you want to play with it. Artificial intelligence, as I mentioned, so here this is the chart of Google versus Microsoft. As you can see, this is the big move. There is that was clearly the winner versus the loser, and Google did a bit of a fuck up with their presentation, but overall that tells you that there is a lot of flows going into those names, into sectors, in industry to identify. So for UID generation, that could be an interesting one, not an easy one, because you don't want necessarily to go to overcrowd. And then on Thursday, we had a big print. What is his name? Croissant, whatever his name on Twitter, mentioned it, that Carl Icahn probably bought 21,000 S&P put weekly, meaning expiring next Friday, which gives you roughly a notional of 5 billion with the 40-50 as the strike, and clearly that didn't help the market. So we had so far until 3 days ago the market really going higher and higher on gamma squeeze, with volatility going lower and lower. And as volatility is going lower, as we explained before, when the implied volatility is too high and the market is actually pricing not much, suddenly some investors are selling the volatility and stocks, and the risk on is ongoing. Suddenly what we had this week is in a tape where was a bit less where people were less, where there was less volume. Suddenly when you get this big print, that inverted the narrative, and as we saw with the VIX, we went on the VIX from 18% to 21-22%. So change in the narratives, and that leads us into the next page, which is the catalyst for this week, going into Friday, where we get the option expiry. So option expiry, as you can see here, for many of the weeks before going for this week, OPEX week for the S&P 500. S&P has been pretty weak. So that has been unless twice in March and October, but very much weak. And that tells you as well that the market is very often changing around those option expiry. And when I say the market is changing, that means the structure and how the option, the open interest, the gamma, the positioning is turning. Interestingly, if you're checking about the CTAs positioning, they have been turning bullish on many asset classes. So bullish euro, bullish Japanese yen, bullish what I'm saying, S&P 500, MSCI. So that means, to me, the pain trade for many of CTAs and actually for many people after covering their shorts a week ago is for the market, for equity market to go lower. So to me, this is the pain trade going lower. Not to me because I'm positioned, as I said before. So I have a put spread on the S&P and some short in Europe. But the most important number of the week is obviously Tuesday with the CPI. So CPI in the US, we know that the numbers are coming down from a very high level. What is important is, first, most of the revised numbers have been on the way up. Secondly, there is a big change in the way the calculation of CPI has been done. So that means the headline number that could come on Tuesday could be very different from what market participants are expecting. So you could expect a lot of volatility. As always, this is a tough one. What we can see from the most recent CPI days, the four last ones, the S&P has been up on the day. So that is CPI inflation. We get as well retail sales on Wednesday, PPI a bit more inflation on Thursday, and some leading indicator, China M2 money supply. Earnings season, this is here, so less and less companies because many companies already released their earnings. For the week, we have 68 issues for the S&P 500, which makes 7.1% of the market value, with most of them on Tuesday, Wednesday, and Thursday. Looking now at the implied volatility, looking at the SPY weekly straddle, the market participants are pricing 2.5% move on the week, which is above the 1.8% from last week. If you think that obviously we have CPI, that should bring some volatility. So this is for the week. Keep into account as well that there is still a lot of Fed governance that will be talking. So if you look at the CPI on Tuesday, we should be looking at this Thursday when we get Mester, Bullard, and Cook. The first two are important and they could be market movers. So this is overall the picture for the week. Again, higher terminal rate for longer. So in terms of the Fed expectations, we have been more hawkish than we were 10 days ago. Interestingly, the market get very excited 10 days ago, the equity market saying, not Bullard, sorry. Powell is very dovish. This is very positive for stocks. And since then, the credit market is actually pricing a more hawkish Fed. So we are talking 30 to 50 bips difference between today or yesterday and the FOMC meeting. So if you have any questions or if you want to join the community, if you like what you see, just subscribe to the YouTube channel or put a like. That's something that we will appreciate. And again, join us on the trading community on Discord. This is for free. And I hope you enjoyed the content. See you next week. Bye-bye.